Welcome. My name is Robert Hopp. I'm an employment service coordinator, suicide prevention trainer, and money management coach at Volunteers of America of Illinois. I'm also an Army veteran. Today, I want to talk about money management, the dollars and cents, SENSE, of money management. So, the key component of money management for any of us is budgeting, having a budget and using that budget to effectively and efficiently manage your income and expenses. I often ask the question when I meet with someone for the first time or in a small group setting, what is a budget and why is it important? Let's look at that. A budget is a spending plan based on income and expenses. In other words, it's an estimate of how much money you'll make and spend over a certain period of time, such as a month or year. And it's important for your financial health and well-being to know how much money you make or receive and how much and on what you're spending your money. It is used to help manage your money effectively with your desired lifestyle in mind. I want to emphasize that it's used to help manage your money effectively with your desired lifestyle in mind. A lot of people feel that a budget is a drag, something that is a real burden. And, I'll be honest with you, it can be, it's work, it takes some work to put one together. But it is, once set up, it's relatively easy to maintain. And it really is a key to achieving some of the financial goals you have for your health, financial health and well-being, and for the enjoyment of the lifestyle that you have in mind. All right. So, how do you create a budget? How to create a budget? Okay. Two things. One, you have to determine your monthly expenses. So you're going to track your expenses. And you need to determine your net monthly income. Now, net monthly income is what you bring home. Gross income is the total amount of money that you earn or receive in a given pay period, or which could be bi-weekly or monthly or weekly. Your gross income is the money that you earn before deductions are taken out of it. Okay. So your net monthly income is what you actually have after all those deductions are made. And that's what you should base your budget on, your net income, not your gross income. All right. The next thing you need to do is subtract your total monthly expenses from your net monthly income to determine your discretionary income. Discretionary income is sometimes called disposable income. That's the money that's left over after you've paid all your essential bills for a given period of time, such as rent, utilities, car payment, those sorts of things. And that discretionary income, what you have left, is what you can use to put toward a vacation trip, purchase of an automobile or some gift for someone, things like that. Okay. And when you are creating your budget, there are a couple of things you need to be aware of and to plan for. One, unexpected expenses, and two, planned expenses such as insurance payments. So when you're creating your budget and you're trying to determine how you want to use your discretionary income, you want to think about things planning for unexpected expenses, what we call an emergency fund, is very important. And you want to make sure that you're aware of and plan your expenses, those planned expenses such as insurance payments. These are your property taxes, things like that. You know that at a certain time every year you're going to have to pay a certain amount of money that's set for certain things. You want to make sure you include that in your budgeting, okay? Now, when we think about expenses fall into 5 major categories, and these fall using community spending guidelines, you can look at these. There are certain percentages, recommended percentages, of your net income that should be spent on these five categories. And the first category is housing. It's recommended that you not spend more than 35% of your net income on housing. Now, these percentages, let me say at the outset, can vary depending upon where you live, cost of living, and things like that. But this is a pretty good benchmark that you don't want to spend more than 35% of your net income on housing. The second category is transportation. That can be your car payment, insurance, and fuel costs, or that can be your public transportation costs for a month. And that should not exceed more than 20% of your net income. The third category is investments and savings. And I think for a lot of us, savings is probably what we're looking at. We may have investments, you may be able to do that. But in either case, 20% of your net income should go towards savings. And that is an expense. Don't think of your savings account, your emergency fund, or your investments as money that you can just use for anything at any time, no matter what. They're not assets. This isn't money that is considered to be an asset. It's actually an expense. That's the way you should look at savings. When money you put into your savings account should be seen as an expense, and that's really where it goes on your budget. Then you'll have other expenses, which can include personal care items, so laundry costs, child care, things like that, pet costs and things like that, co-pays for insurance and over-the-counter medications and things like that. And finally, the fifth category is debt, which should not take more than 5% of your net income. Okay. Now, let me say this. If you add these up, we have 100%. Okay. 20, 40, 60, 35 is 95, and 5 is 100%. So obviously, if you're going over in categories and you're at the max in all the others, you're spending more money than you're taking in, which is not a good situation. If you are spending exactly the amounts of percentages in each category, you're breaking even, which is not bad, but it's not the ideal situation, and you want to work on reducing your expenses in any one or more of those categories so that you have some extra money to start investing or putting away additional money in savings or an emergency fund. And so the big picture is 100%. Now, I want to say this. You may be spending 40% on housing and only 10% in transportation. So although you're spending more in that one category, overall you're still spending less than 100%. And that's not a bad situation to be in. But you still want to try and focus on reducing that housing cost if possible. All right? So use this tool with your budget to manage your money and plan for major purchases. Okay, that's what you want to do. That budget tool, that spending cost, you want to use that with your budget to really plan. Sorry, let me go back. Use this tool with your budget to manage your money and plan for major purchases. Because if you know that you're doing well in any of these categories, let's say you're doing the 20% of savings or investment, every other category, you're either right on or you're spending less than the percentage. You can now plan for a major purchase and know if that's something that's possible for you to do without breaking the bank, so to speak, without going over your budget, okay? So now, I spoke a little bit about this on the previous slide. Building a savings emergency fund. You're planting a seed, okay? It's very important to start doing this as soon as possible. And it doesn't have to be a large amount of money that you're doing this with, okay? So why is it important? Okay, an emergency fund is a pool of liquid money set aside for unforeseen expenses like a medical expense or a car repair. An emergency fund insures against life's unexpected expenses, and having a robust emergency fund gives you peace of mind. You don't have to worry about, let's say, a typical one, and this happened to me recently in the last couple of years, a major car repair that I wasn't planning for. Now, I do have several credit cards. I don't like to use them too often, and I try to manage them well. And so I had a significant emergency fund, and I was able to cover the cost of this unexpected automobile repair using that emergency fund. Uh, and I've started rebuilding that emergency fund after that. What is nice about this is I didn't have to use my credit card. I didn't have to take out a payday loan or a title loan. I didn't have to borrow money, anything like that. Okay, and now let's say you've got a smaller emergency fund and the expense is twice as much as you have. You also have a credit card. Okay, so you can split the cost, and therefore your the amount of money that you have on your credit card is half of what it would have been if you hadn't had the emergency fund. So that's why it's important to have savings and emergency fund. Okay. Now, how do you do that? Okay, there are a couple of ways. One is to set a SMART goal. A SMART goal is specific, measurable, action-oriented, relevant, and time-bound. So let's say you have no emergency fund right now. You choose an amount, say $600. You want to have that $600 in emergency fund in 6 months. We'll make it simple. You know that you have to put $100 a month into that savings fund. Um, so it's specific. You can measure it because you know how much you need to put in every month. And if you're not meeting that goal, you can examine why and take action. It is action oriented. You've got something that you are going to do and it's going to achieve a goal. It's relevant to your situation. It's important because it's part of your financial health and well-being plan. And it has a time limit. It's time bound. A goal without a time limit, without an end date, a reasonable end date, is no goal at all. Okay. There's also another way to do this called the 52-week money challenge, and that basically, I'll give you a quick synopsis of that. First week you put $1 into a tin can. The second week you put $2 into that can. So now you got $3. The third week you put in $3 into that can, and now you got $6. The fourth week you put $4 into that can, and now you got $10. You continue to do this for 52 weeks. All right. So at the end of 52, on the 52nd week, you put $52 into that can, and you end up with $1,378. Okay. Sounds wild, doesn't it? It certainly did to me the first time I saw that. But it does work. All right. So you're never going to put in more than $52, and that's on the last week. All right. It works, and I think it's something that everyone should consider. If you're having, once you reach a certain amount, you can obviously take the money out of the tin can and put it into a bank account or a credit union account that way, which is more secure and might even earn you some small amount of interest. But there you go. All right. Now, I want to say for those who qualify to receive or are currently receiving temporary financial assistance (TFA) from our agency while you're working with us, this is a real priority. All right, because many of your expenses are either partially or fully covered for a time, which means any money that you have that you're earning or receiving is money that you can really use to build this savings or emergency fund. The other thing to be aware of is you might have spending leaks. All right, spending leaks are like holes in your pocket. They're things like buying 3 cups of coffee a day at 7-Eleven, which the average person does and spends close to $1,500 a year. Spending leaks are things that are you just don't notice them because they're really so small, but they add up very quickly. You want to try and identify them and eliminate them. You identify them by keeping track of your out-of-pocket expenses. And you eliminate them by deciding what things are worth it and what things are not based on your overall goal for financial health and well-being. Okay. Now, I know credit scores. Credit scores are you have a credit score and you have a credit report. We're going to talk about credit scores right now. Everyone has a credit score. People with poor credit, no credit, bad credit, great credit, all have a credit score. Okay. There are credit scores you can receive through, say, Credit Karma. Those are scores like that are really educational scores. The score that, and they're not inaccurate, but they're not what lenders typically use to determine whether or not you're eligible to receive a loan. The score that is used by lenders, kind of the gold standard, is called FICO. And so what is a FICO score? A FICO score is a credit score developed by FICO, a company that specializes in what's known as predictive analytics, which means they take information and analyze it to predict what's likely to happen. In the case of credit scores, FICO looks at a range of credit information and uses that to create scores that help lenders predict consumer behavior, such as how likely someone is to pay their bills on time or not, and whether they're able to handle a larger credit line. Okay? So, what's the key here? Behavior. Um, and that really is the key to having a good credit score is your behavior, what you do with your money, and what you do in terms of paying back your loans. So there are 5 key ingredients that impact your FICO score. You look at the pie chart there, you can see. The first one is your payment history. That's 35% of your score. That is the key uh, to your credit score. All right. The second is the amount of debt or credit utilization. That's 30% of your score. Okay. The fourth is length of your credit history. That's 15% of your score. The fourth is credit mix. That's 10% of your score. That's the types of credit that you are using. So creditors, lenders typically like to see that you have a mix of credit. So say a credit card or two, a loan for a home, like a mortgage or a car loan, maybe some those kinds of different types of credit. They see that as a positive thing. And fifth is new credit, 10% of your score. Let me just go over these very quickly. One, payment history, 35% of your score. All right, this is important. If you have 3 credit cards and you have debt on all 3 of those credit cards, it is very tempting to want to just pay off the one with the largest amount and not do anything with the other 2 until you pay off that first card. Please do not do that. You're not helping your credit score because your credit score is looking at all your behavior, meaning it's looking at the fact that you're not paying regularly on 2 out of the 3 loans you have. Okay? What you need to do, and I'll talk more about this in debt, in the section on debt, is the thing you need to do is to make the minimum payments on all 3 of those credit cards. And then determine if you can make a larger payment on one of them so that you can start to pay that one off, but you're still going to keep paying on the other 2 cards. This way, you look like someone, based on the data, who cares about paying their debts off and who has the habit of doing that. And that's going to improve or maintain a good credit score. All right. Now, the amount of debt or credit utilization, real simple. I'm a lender. I give you a credit card for $1,000. You can use up to $1,000 on that card before you can't use it anymore. You use typically $50 a month, and you pay it off every month. No, one month you spend $150 and you pay off $50 and you've got $100, and you carry that for a few months. You're only using 1/10 of your credit card, or 1/10 of the amount of money that you can use. That's a pretty good credit utilization percentage. It's not 30%. Okay. On the other hand, if you use 300, 400, 500, you've gone at or above 30%, okay, of your credit utilization. That can start to negatively impact your credit score. Okay. Now, length of credit history. This is also another one. People get in trouble doing this one. If you have 2 or more cards, do not close the card that has the longest credit history because your score will be negatively impacted by that. All right. Remember, they're predicting behavior. The way that they predict your behavior is by analyzing data that's based on the length of time that you've had a credit card or a loan. So you don't want to close out your older card. You want to, if you're going to close a card, you want to close a card that has the least amount of history. Okay. Credit mix, we went over that a little bit. That's very simple, just having a mix of different types of credit. And then new credit, you don't want to open up a whole bunch of loans, particularly credit cards at one time. that can start to impact your score negatively because uh, lenders will typically see that as possibly you don't have sufficient liquid income and you're opening up a lot of credit cards, and that indicates that you might not be a good credit risk. All right. All right. So let's move on. Now, ways to build and improve your credit score. The first three here: pay all your bills on time every time, keep your credit card balances low, open new credit only when you need it. Those are taken right from, those are three of the five things that impact your FICO score. Okay. There are other ways to build and improve your credit score as well. One is obtain a secured credit card. And secured credit cards are cards that you put a deposit on and you're allowed to use up to or maybe a little bit more than the amount of that deposit. Then as you pay that off, it's usually a small amount of money that you're allowed to use. As you pay that off, your credit score starts to improve. Uh, One thing you need to be aware of: there are cards out there that the company says is a secured credit card, and it really isn't. It's just a reloadable debit card that doesn't report to the credit agency's bureaus. All right, so you have to be cautious. You have to be careful and really do your due diligence and research the card. Okay. Another one is to become an authorized user. An example: my daughter had a poor credit score. She spoke to a credit counselor. The credit counselor advised her to see if she could become an authorized user on my account because I have a good credit score. And she proposed that to me, and I thought about it. I looked at all the angles in that, and it turned out that as long as I kept the card and not give her the card, uh, she would benefit from my credit score history, and she would not be able to negatively impact my credit worthiness because she's not using that card to purchase anything, right? Now, you have to be cautious. If you ask somebody to do this and they start to have problems with their problems with their credit will negatively impact your credit score. Okay. The third thing to do is to open a self-credit builder account. It's a way to build credit using a self-credit building account. You make a deposit, use the money, you pay the money back, and at the end of that time, when you're done at that period of time that you have that loan, you get the money back, and you've got a great payment history. Okay, so those are three other ways to build and improve your credit score. Now, your credit report. Understand your credit report. What is on the report? Okay, there's personal information: your name, your address or addresses that you've lived at, where you've worked, things like that. There are going to be public records, such as if you defaulted on a house, you lost your home, something was repossessed, some kind of a lien, which is a judgment put on through the court that says if you sell this piece of property, the lender has the right to come in and take that, the proceeds from that. It's going to have account information on every account that you currently have and have had in the past. It's going to list accounts that are satisfactory. It's going to list potentially negative accounts, meaning those accounts were closed without being paid off, or they're in collections and things like that. It's also going to show credit inquiries and where those came from. They're going to be hard inquiries, which are inquiries related to, say, purchasing a home or purchasing a car, things like that. And soft inquiries, which are just people doing a regular little background credit check for, say, you want to rent an apartment, things like those. Hard inquiries will impact your credit score, as will soft inquiries, but soft inquiries generally don't impact your credit score for more than, say, 30 or 40 days at the most, and they're relatively low impact. Hard inquiries can impact your credit score, and that impact can remain for a longer period of time and be a little bit more significant. Now, your credit report. You need to check your credit report at least once a year. All right, this is important. People say, why? Well, you want to make sure that the information is correct and up to date, right? You want to see if there are any errors or mistakes. Those things can all negatively impact your credit score. And if there are mistakes, these are things that can be corrected, and once removed, can start to improve increase your credit score. So that's why it's so important. So some common mistakes would be, say, loans and credit accounts you've never seen. That's also an indication there may be some identity theft going on. Okay, there may be misspellings of name, wrong social security number, wrong address, or even phone number. Those things should be corrected, removed, and or corrected. Accounts may be wrongly listed as late. There may be incorrect balances, incorrect credit limits, closed accounts listed as open, and incorrect delinquency dates, or accounts listed more than once. These are all things that can negatively impact your score. If you have an account that's listed more than once, obviously that's a greater amount of debt, right? So you want to get that removed. If you look at the pie chart, you'll see the Consumer Financial Protection Bureau received nearly 45,000 credit reporting complaints last year. This is from 2018, I believe. The vast majority were related to alleged errors in a consumer's file. So that's why it's so important to pull your credit reports at least once a year. Now, debt and how to pay it down. Uh, if you have a reasonable amount of debt, and I can, if you have a reasonable amount of debt, let me say, you can use one of these two methods to pay that debt down, and it is very manageable. Okay, uh, and the first one is the avalanche method, the debt avalanche method. So I'm going to go through this. I want to just go through this with you. Pay debts for this method. Pay debts in order of interest rate. You start with the highest interest rate. All right. Now here, please pay close attention. Focus on paying off one balance at a time in order of interest rate. And here it is. Listen to this. While still paying minimum balance on all other debts. Remember when I talked about credit score and the thing that what impacts it the greatest is payment history. That's 35% of your score. I use this to illustrate that, and I want you to make sure that you understand this. All right? You want to still pay the minimum balance on all the other debts. Now, the benefits of the avalanche method, you pay debts off faster and you pay less interest, because a high interest rate means you're paying more money for that loan every month. And the sooner you pay it off, the sooner you're gonna pay less money for that. Okay. The other method is the debt snowball method. You pay debts in order of balance amount. You start with the smallest balance. If debts have the same balance, input debt with higher interest rate first. And again, pay close attention. Focus on paying off one balance at a time in order of smallest to largest while still making minimum payments on other debts. That is so important. It's the same as the other one. Continue to make your minimum payments on all your other debt, because that's your payment history, 35% of your FICO score, your credit score. The benefit of this method is that you get quick satisfaction. You're going to pay off that a small balance pretty quickly, and then you're done with that, and you can move on to the next one. All right. So I just want to share these with you, a couple of additional resources. A Mint app, it's a free money manager and financial tracker app from the makers of TurboTax, and it's a good way to manage your income and expenses without having to do that on a piece of paper. All right. You can, as you can see, you can use that. It connects your credit accounts, credit cards, and bills, investments, so you know where you stand. You can keep track of your credit score to help you be smart about it, and there's no credit card required. Okay. Consumer Financial Protection Bureau, the CFPB, is a great resource for you. They provide, it's an agency of the United States government, and they provide consumer protection. And the Consumer Financial Protection Bureau helps consumers by providing educational materials and accepting complaints. Okay, they're great. Check out their website. And then there's also the Veterans Benefits Banking Program, the VBBP. Veterans and their beneficiaries now have additional options for receiving VA benefits via direct deposit, as well as access to financial services at participating banks. And there's the website. All right, so I'm going to leave this up for a moment. I just want to say, I know I've given you a lot of information, and I think that if you focus on this, though, on budgeting and creating a simple budget for yourself, you're going to be taking a huge step toward financial health and well-being, and achieving the lifestyle that you would like to have. All right. Again, if you are a current client of Volunteers of America of Illinois receiving temporary financial assistance, this is a key, an essential part of your working with us. And if you would like to talk more about some of the particulars of your financial situation, we'd like to get some coaching, please talk to your service coordinator, and he or she can make a referral for us to meet and talk to discuss further anything related to this topic. I want to thank you for your participation and attention today, and have a good day.